What is the economy going to be like in 2025? Well, that's a big question. And for big questions, we bring on a big guest. And today we've got Andrew Updike, who is a economist, and he breaks down what's the economic landscape. How is it going to affect us? You want to listen to this all the way through.
We hope you've been enjoying all the episodes from Secure Your Retirement. If you'd like to keep learning and receiving these episodes, hit the subscribe button and the bell so you receive alerts when they come out. We've helped thousands of listeners get on the path to securing their retirement. Now it's your turn. Let's dive in.
Welcome, everyone, to Secure Your Retirement. We are excited. We look forward to this particular week, special episode that we do every quarter with Andrew Updike. So, Andrew, thank you very much for coming back on to Secure Your Retirement podcast and letting us pick your brain here about the economics and the economy.
Yeah, thank you so much for having me.
Great. So, we're sitting here first of the year. And we kind of would like to just, throughout last year, we did a few of these episodes and we talked about things as we were moving through. So I guess if you could you kind of like summarize as you now have had a chance to maybe look back at 2024 and say, do you think it was a good year? What was the positives? What were the, things that we always look back and say, this is what 2024 was?
Yeah, no, I mean, at the end of the year, I think it was overall a solid year. I mean, we had economic growth. We didn't see a recession. It looks like GDP for the year was up 2.5%, 3%. Employment continued to grow. It's slowing, but that was expected when you came out and we're seeing excessively high numbers for the employment gains in 21, 22. We knew that would kind of normalize. So it was a year where progress continued. Obviously, major government spending continued. Last year, we ran about a $1.7 trillion deficit. But coming into 2025, it's an environment that does leave kind of a lot of questions. The Fed, going into last year, said they were going to start cutting at some point. They did that. The pace ebbed and flowed throughout the year. If you remember, about a year ago today, the market was expecting for 2024, the Fed was going to cut 6 times. And by the time we made it to the middle of the year, when inflation had been stubborn, it got down to 2. They ended up doing 4. So, we kind of rode with the ebbs and the flows. We're in a decent footing coming into this year, but obviously we had elections last year, and that sets up 2025 as a year where a lot could change.
Yeah, so while you mentioned inflation and the Fed, and I think that's a big focus of what this year is going to be. This morning we woke up to the market, and regardless of the day that this broadcast, we woke up to the morning the markets this morning with a little bit of volatility. One of the reports was around previous jobs numbers that came in, unemployment being stronger than expected, jobs being stronger than expected. And the fear of that, it kind of jarred the markets a little bit today with the fear around, what is the Fed going to do with a stronger than expected economy? So one, could you explain to someone that doesn't do this every day, why is that a concern of the Fed? That, hey, yeah, it's kind of counterintuitive. Economy's doing well. You would think we could cut rates, but why is that not the case? And then maybe go into what you think is going to happen this year with inflation and the Fed. Are there threats of inflationary items going up? And, that could go all over the place with Trump being inaugurated here in a week or two. And so just take that and run with it, Andrew.
Yeah, it's kind of it's counterintuitive, right? It was like good news was seen as bad news from the markets. We got more jobs than were anticipated. The employment market looked healthier than was anticipated, and the markets went down in response. The way I would explain it, the Fed has a dual mandate. The Federal Reserve is tasked with 2 things: inflation and employment, right? And so as employment was weakening, we've seen that slowing down in employment, and there's some weaknesses. If you start to dig beneath the surface within employment, over the last 12, 18 months, the dominant players in employment gains have come from government jobs and healthcare jobs, and healthcare is the largest government subsidized sector. The groups that have been leading job gains are not the typical leaders. If you go back pre-COVID, those 2 groups are making up 12 to 14% of job gains. Now they're running 50 to 60%. But when the number came in stronger, the fear from the market was the Fed has been cutting rates. They're making it cheaper to borrow and buy a house, borrow and buy a car, borrow and invest in a business. All else equal, the market views lower rates as a good thing for companies. And when the employment number came in stronger, it brought into mind this question of, okay, is monetary policy looser than we thought? Are rates already accommodative? Can the Fed afford to cut more? Because if employment is this strong and you continue to cut, there's a risk that you're going to push inflation higher. And that's the major risk for the Fed. When they're looking at their balance of what they're trying to accomplish here in 2025, they'd like to continue cutting rates. But let's, again, remember the last 4 or 5 years for them. 2020, they said there wasn't going to be any inflation. And if we saw any, it would be transitory. They said that again in 2021, and we ended that year with inflation around 7%. In 2022, they acknowledged, okay, we were wrong about the transitory thing, and we're going to have to do a couple rate cuts. They told us in 2022 they were going to do 3 rate cuts, and that would bring inflation down to 2%. They did 17 rate cuts, and here we sit going into 2025. We're still not at 2%. And over the last 6 months, the inflation numbers have started to move more sideways instead of trending down. We're noticeably off where we were 7, 8, 9% going back a few years ago, but the Fed is starting to stumble on a little bit of that progress. And the market's asking, did you cut a little too quick when you started? Is it going to be a slower pace? If you were to go back 3, 4 months ago, the market was expecting 4 rate cuts this year. Now they're down to 1. So I think that's what the market's responding to. The market's saying the Fed is not going to be able to move as quickly as expected. So those lower rates won't flow through and benefit companies as much as was previously expected. And then there's the political wild card, right? And going in, we've got an election year. We've got the Republicans. Trump won the presidency. The Republicans have the House and the Senate. And that sets up the possibility for changes to tax policy, to regulatory policy, to trade policy, to immigration policy. There's a lot of question marks on the agenda in 2025, and depending on how those move, it could really set the stage for how much the Fed is able to move. There's going to be a battle in Washington, I think, here in 2025 between the Federal Reserve and the federal government, and whoever takes that leadership. If we see a lot of change coming out of Washington, that may free up the Fed to make more moves. But if we don't see a lot of traction and the status quo holds, it probably will be a slower year for the Federal Reserve, at least as it relates to rate cuts.
Yeah. So I guess, as we're sitting here in the first part of the year and we think about this administration change that's coming, what do you think? I mean, as you look at things, it does sound like there is a lot of items on the agenda, and it looks like the new administration is going to appears to be move very quick, try to get some things accomplished right in the beginning of whatever that might be. What do you see kind of happening here first quarter as far as maybe some of those things that you think might get accomplished, as well as how that's going to affect the markets?
Yeah, there's going to be a lot of talk. That's for certain. When you look at what the administration has said they want to accomplish coming in, it's not that different from the first go around with Trump. If you remember, going back to 2016, 2017, Trump came in and says, I'm going to be tough on immigration. I'm going to be tough on trade, particularly China. I'm going to cut tax rates. What's he saying this time? Wants to cut tax rates, again, corporate tax rate. One of the questions coming into this year that was going to be decided by the election was those Trump-era tax cuts we got that started in January of 2018. Those were set to expire here at the end of 2025. And depending on who was in office, we could have seen those completely expire and rates move back higher. We could have seen, if there was a mix between, let's say, the House and the Senate, we could have seen a situation in which some of those passed. With the Republican sweep, we're going to see the full extension, I expect, of those tax cuts. So now the focus has become, we know we can pass that. That's what the administration is saying. What other regulatory pieces can come through? You've heard, if you turn on the TV, about the trade negotiations with China, with Canada, with Mexico. They're looking to, similar to the first go-around, try to stabilize or really ingrain relationships with trusted trade partners and in areas where they feel like people aren't living up to their commitments that have been made, at prior points in time, put a little pressure on. Now, again, Trump is volatile. Right? We all know that, whether you love him, whether you hate him. Personally, I hate politics, but I care a lot about policy. And so the questions are going to be, how much of this is emotion? How much of this is him tweeting? And what do we see from action? And the people that he's putting together, I think there is going to be, in those initial weeks and months, there's going to be a lot of focus on the immigration and the trade. And I think as they figure out some pieces on that, the tax cuts, I think you will see this year. I think the corporate tax rate, which is currently at 21%, back in 2016, it was at 35%. I think that's going to go down to somewhere in the 15 to 18% range. I think 18 is the number, and that'll be a tailwind from the earnings standpoint for U.S.-based companies. But it's really, I would argue, the biggest wild card this year is the Department of Government Efficiency. They've got Elon Musk coming in and Vivek, and they're saying, hey, let's figure out, we ran $1.7+ trillion deficits each of the last 2 years. That's the kind of spending we do in a recession. That's the kind of spending we do when we are in an active war, and we weren't in either one of those here the last 2 years. If they get traction, if they come in and say, okay, we're finding areas to cut, and they're able to pull back on government spending, it does two things. One is it slows economic growth in the short term, right? Because if government is spending $1, if they're buying activity, they're building a building, they're putting in plumbing, they're buying, planes, that does add to activity in the economy. So in the short term, if that goes away, you could see some economic volatility, but it also would ease some of the inflationary pressure. So that's what they're really looking at going into this year. There's going to be a lot of areas to watch, but again, we also look at history. Okay, this is not the first time that something like this has been tried. If you go back to 1982, under Reagan, we had the Grace Commission. And the Grace Commission, they took 36 working groups over 18 months, had them go all around Congress, all through government, and try to find areas where they could make things more efficient. They came back to Congress with a recommendation list of 2,500 items. Okay, and these 2,500 items, they said, hey, if you do this, if you implement these, we believe you can save about $500 billion over the next 3 years. And that was in 1982 dollars. But ultimately, finding what you see as efficiencies and getting Congress to commit to make changes, there's a lot of interest groups that are involved. Getting the actual change is much harder than proposing change. And that is going to be a critical question here in 2025. This could go down as a year that the economics classes look back on, the textbooks use as a case study. But it really just depends on whether it's all talk or whether we see action. And that only time will tell.
Yeah. While we're on politics, one more question I've got. Maybe you could take a minute explaining it. I think, the buzzword has been one of the buzzwords in the whole political cycle here over the last few months has been tariffs and how that could help things out. I think there's a misunderstanding of what a tariff is and who is actually paying that. So could you give us just a little explanation as far as what a tariff is, who pays that, and how does that impact us?
Yeah, no, it's a great question. Tariffs, I think, are often misunderstood. The idea behind a tariff is you've got somewhere, we'll use China as an example because Trump put tariffs in on China during his first administration. In areas like steel and aluminum, China was getting subsidies from the Chinese government. Chinese companies were. So they were able to produce and export steel and aluminum at lower costs than any other group unsubsidized was able to produce at. And so here in the United States, they said, look, steel and aluminum, we need those. We need the capacity. We need the ability to be able to produce those. We need it in wartime. We need it for infrastructure. We can't be reliant on foreign governments for that. So when they put a tariff in place, essentially what it was is the tariff says anything that's being imported from Chinese steel and aluminum gets imported into the United States, a tariff is going to be paid. Now, ultimately, it's not that China's sitting there and China's paying the tariff and no prices change here in the United States. Realistically, what happens is it pushes prices up and consumers buy, right? Consumers are the ones that ultimately pay the price as businesses pass through that higher cost. But tariffs are also tricky because they're a bit like Swiss cheese. If you look back at the tariffs, again, with steel and aluminum, when they got announced, because when a tariff gets announced, it doesn't apply immediately. From the discussion to implementation on that tariff, it took about 11 months. And during that 11-month time period where they figure out logistically how this works, how are they going to apply it, where are they going to apply it, companies are allowed to apply for exemptions. There was close to 500,000 companies that applied for exemptions on steel and aluminum. You had companies that produce medical devices, and they said, hey, look, if you don't exempt us, prices are going to go up for medical tools. And then you had companies that were doing things like child car seats. So people hear tariffs. They hear, oh, we're going to put tariffs on China. We're going to put tariffs on Canada. We're going to put tariffs on Mexico. Well, Canada and Mexico are much harder to put tariffs on than China because we have a standing U.S.-Mexico Canada free trade agreement that got put in under Trump 1.0. I would look at that as a lot of political posturing, saying, hey, look, we've got some disagreements, whether it's related to the border or industries, oil, auto manufacturing. Like, we know there's disagreements. We're going to vocalize them. Let's bring everybody to the table and figure things out. When we see tariffs, I think they're less impacting than many people presume, but they do have an impact. If you look at U.S. and China trade relations over the last 8 years, U.S. purchases from China are down about 25%. What it does, if there's uncertainty, and particularly as the U.S. applies tariffs, it makes companies, because so many companies today are global companies, they look at it and say, if we're going to interact with the U.S., if we're going to sell to the U.S., maybe China's not the place we want to be. And so they moved a lot of activity. S&P 500 companies, European companies, Asian companies ended up moving, not necessarily bringing that activity back here to the United States, but we saw a pickup in activity with Vietnam, with South Korea, with France, with Malaysia. At the end of the day, after the tariffs in Trump 1.0, the U.S. bought more from international partners than they did before the tariffs. It didn't lead to a reduction in purchases. It didn't lead to a reduction in trade activity, but it did shift who that trade activity took place with. So when you hear tariffs, you will see them go in action against China with a lot of Canada and Mexico. I think there's a lot more bark than bite. It's posturing, and I wouldn't spend too much time being overly concerned about the discussions there.
Okay, great. So every time we do this with you, Andrew, we like to kind of do this thing where we ask you your concerns and then what you're looking forward to end on a positive note. So as you look at 2025 and all these things that we're talking about, when it comes down to real concern that, we could even say, if this happens, that's going to bother me, or that's going to be a scary thing, or what is it that you think maybe is already in place that's going to be something that could be a difficult scenario? What is your concern looking throughout 2025?
One which I think we've talked about before. I mean, you're noticing there's a lot of like a political turnover happening around the world. You saw it with Justin Trudeau in Canada. You've seen it in France. You've seen it in Germany. There's been discussions in the UK. One of those hot button items that's been out there that remains on the radar is China with a place like Taiwan. The U.S. has made tremendous strides in terms of starting to bring more of that chip production to the United States. The TSMC plant down in Arizona, Samsung in Texas, the plant that Intel's building. But there is still a lot of geopolitical uncertainty out there, and that can bring inflationary. What's going on in the Middle East with Israel and Gaza, Hamas firing on the ships in the Red Sea is putting a lot of pressure now on some of the trade that's going through that region. It's pushing up global freight rates. So I think geopolitical instability is still something certainly to be watched. But quite honestly, for me, one of the bigger concerns over time, again, this could be a year we go back in the history books and look and say, hey, we made some changes. There's agreement really on both sides of the aisle, and even from outside groups like the International Monetary Fund. We can't continue to run $1.7 trillion deficits. It's not sustainable. We can't continue to run deficits that are growing faster than our economy is growing. And so one of my concerns this year is if we start to see movement on it and it peters out, that this is a chance to kind of get the ball rolling. And again, I hate the politics side of it, but it's not a Republican thing. It's not a Democratic thing. It's one of those times every few years, every few decades where both sides of the aisle have to sit and look and say, okay, where is change needed? You've probably heard things like Social Security are set to run out of full funding in the next decade. It's time to get the fiscal house in order. It's time for both sides of the aisle to come together and say, let's address this. So my concern is we're not going to get enough traction there, and it's going to lead to a bigger fight over these issues in a year or two or three. But there's also a lot of potential there.
Yeah, so let's end this one today here on a positive note. So obviously there's a lot of uncertainty coming into this year, and there's a lot of things that will be said and then actually what will be done. So what are you excited about going into this year as we walk into 2025? And how does this year play out?
So one of the things I'm most excited about is we're starting to see things broaden out. We're starting to see more participation. If you look at earnings growth expectations for this year, you're starting to see more activity coming from small and mid-sized businesses. You're starting to see it come from some of the areas that haven't participated as much over the last 2 years. And that's the sustainable growth that we need. I think you're going to see that in employment. Again, I mentioned it's been heavily concentrated over the last 12, 18, 24 months in government and healthcare. I think you're going to see that start to broaden out. I'll tell you, I love to read. Right, I love to read over the Christmas break. I think I got through 5 or 6 books. And the more that I read, the more that I look at what is taking place, we have unbelievable tools today. If you haven't read, I think with Elon Musk coming in and Doge, right? I wanted to read a little bit more. I don't know much about Elon Musk. So I read the Elon Musk biography by Walter Isaacson. Fantastic book. And again, whether you hate him or you love the guy, just like with Trump, he's an interesting character. And when you look at what's been done, I didn't realize the scope to the degree of what's being done with SpaceX, what's being done with artificial intelligence, what's being done with solar production. We are making massive technological strides now. We are moving at an incredibly quick pace. And a lot of times those business advancements, those improvements kind of get pushed to the background because of all the political fighting that's taking place. But the tools are there, right? We're seeing a broadening out. We're seeing unbelievable tools put to work. We're seeing progress that wasn't, I think, feasible 10, 20 years ago because the technology didn't exist to allow us to apply new ideas, to try new things out. So there is, again, this is a year of promise. Okay, there's a lot of unknowns, but this is also a year where we're hitting strides with certain technology, strides in certain industries. And this year, as we end 2025, if we're having this conversation in 12 months, I think we're going to look back and say earnings were probably up for the year for companies. There was a broadening out. It was a more sustainable growth path. It's a growth path that gives us building blocks to build off of into the future. And that's necessary. The concentrated positioning we've seen over the last 2 years, concentrated movement over the last 2 years, most concentrated, quite frankly, that we've seen since the late 90s, that was always going to be difficult to maintain. So broadening out, leveraging the tools that we've got, I think provide a lot of opportunity in the year ahead.
So a quick follow-up to that, because you mentioned AI. I was listening to a different podcast, and they equated AI and the boom and the excitement that happened all last year. Obviously, tremendous growth that drove the markets. It was the reason that the markets were up as good as they were last year. And so we walk into this year. Do you see that level of growth? I know we're seeing broadening out, but do you see that level of growth continuing? An analogy that was made is when the iPhone first came out. The first 5 iPhones, you would see dramatic differences between 1 to 5 and then to 10. But here over the last few years, the last 4 or 5 iPhones, kind of slowing down as far as innovation there.
Sure.
So that was an analogy made with AI. Obviously, I don't think we're there yet. But
Yeah.
What are your thoughts on that?
I kind of look at AI like the internet, where it's like the internet, it's one of those things. If you look back now and ask anybody, what was the most influential technological change we had in the last 50 years? I think most people would agree the invention of the internet, the rolling out of the internet, right? The way that we've engaged with it was arguably the most transformational technological shift we've seen in the last 50, 60, 70 years, just like electricity was in the early 1900s. But it took a little while. It took a couple of years for us to figure out how to use it. I think AI is still in those phases. But along with AI, when we get new technological shifts, what happens along the way is we're constantly improving the tools that we know we're going to work with. We're constantly building up our electrical infrastructure. We're building up the water infrastructure. We're building up the data. We're building up the chips that we have to use. And a lot of those will get used for AI, but they'll get used for other things as well. So I do think it's still a little early to say, hey, we're going to really see the gains, the earnings, and the productivity show up from AI. I think there's still going to be a little time for that to take place. But I think the building blocks, again, are showing up there. And whether they get used, right? The internet, people are like, oh, everybody's going to buy their clothes online. They're going to buy their books online. And we got there. We ultimately did get there, but we found other uses in the interim that brought productivity gains. And a lot of the value from a market, when we talk about investing, came from areas that were unexpected. I think we're going to see that with AI. Let's give it time, give it some patience. We always overestimate how much technology will impact things in the short term, and we underestimate how much impact it can have over time. Let's look at the whole infrastructure surrounding it. Let's look at all of the other activity that we're building that will prepare us for AI, but are also preparing us to leverage technology, leverage chips, leverage productivity, whether it's through the AI field or surrounding areas. I think there's going to be a lot of side things that ultimately flow through that we look back in 5, 6, 7 years ago and say, we were building for AI and we got these benefits along the way. And I think that's going to be very consequential.
Excellent. Well, thank you so much, Andrew. As always, it's very nice to have your big picture on the overall economy, not only here for us domestically, but from the world's perspective. So again, we certainly do appreciate, we know our listeners appreciate it too. So thank you so much for coming on.
Thank you for having me.
We hope you have enjoyed this episode of Secure Your Retirement. If you would like to learn more, we have actually created an online course called 3 Keys to Secure Your Retirement. This video course helps you to think through all the different steps as you get ready to plan for and live throughout retirement. You can access this by going to our website, pomwealth.net. In addition, you can also subscribe below to our podcast called Secure Your Retirement.
For more retirement tips, check out these videos. Also, if you find them valuable, please subscribe to our YouTube channel and give us a like.